Another closing high in sight for the S&P 500, the record-breaking run forcing many investors to look under the surface of the index at market breadth and extreme concentration. Let's bring in Michael Mauboussin. He's managing director at Morgan Stanley Investment Management. Michael, it's great to have you on.
Great to see you, Mike.
You've done some pretty deep work on not just the history of concentrated markets within the S&P 500, but kind of what drives it, and I guess whether to be worried about it, because people mostly talk about it as somehow a risk or a distortion or something to be concerned about.
Yeah, exactly. The first thing I'd say is, going back, we went back to 1950, try to get 75 years of history. We're now at year-end at 27%. Last night, we're at 31%. This is the top 10 stocks of total market capitalization. Last time we were at this level was 1963, and you have to really go back to the 1930s to see a sustained period of this. So the fundamental questions you get to is, why is everybody so worried about this? And I think the thing that's really been disturbing for investors is the sharp rise over the last decade. So the last 10 years has been the largest increase in concentration we've ever seen.
And I guess, there have been some who've said, look, it just reflects dynamics within the economy, whether it's kind of a winner-take-most economy for the biggest names, or a willingness to put a heavy premium on certain types of companies, or is it somehow a mispricing? Is it an overvaluation? Is it a misallocation of capital?
And it might be all of the above. But there are two things we can point to that are interesting. One is we looked at just large cap versus small cap stocks and their return on invested capital, right, which is a measure of their economic performance. And that gap was about 80 basis points differential in the 1990s. And that gap has opened up to over 400 basis points, so 4 percentage points. So the underlying economics are better. The second thing we looked at, this is going to sound a little fancy, but we use a term called economic profit. So it's really return on capital times the amount of invested capital. And turns out the top 10 companies last year, which are again 27% of market cap, were almost 70% of the economic profit. And if you actually go back over time, even when those concentration numbers were in the teens, it was 40, 50% of economic profit. So there may be some other things other than fundamentals, but there's certainly something that underpins what we see.
There was a fascinating piece, kind of a counterfactual in your work, which was, you have to test the idea that maybe when the market was much more balanced, let's say in the early 90s, it wasn't concentrated enough. In other words, the market was missing the point that there were going to be these huge winners.
Right. When you look around, two things to say on that. One is you look around the world, we're the top 12 markets in equity cap, we're the fourth most diversified. Now, it is the biggest market, but it's the fourth most diversified. So actually, this is not unusual if you take it on a global level. But yeah, we did that counterfactual, which was to say, if the prices were right at the end of this year, what should they have been 5 years ago or 10 years ago? And you're exactly right. They should have been much higher. So, you're arguing the markets are efficient now and they're inefficient before. It could have been the other way around. You could argue it both ways. But that is an interesting thing. Again, it's just because we're in new territory. I'm just about observing, not predicting, just observing what could make this be.
Because it is interesting, because the other periods you mentioned, the early 60s, where you had this extreme concentration, and then another one that was almost as concentrated, let's say around the top of the market in 2000. Well, after the early 60s, you had pretty good markets for a while. After 2000, you had a rough decade.
Yeah.
So that in itself doesn't tell you a lot. What I did like is the history of whether you want to own the largest stock in the market or the second or third.
That's an amazing story. So we went back to 1950 to create an index. So it starts at 100. And if you just own the top stock for every year, so it rotates, right? That index went from 100 to 4, 1, 2, 3, 4 in 2023.
Wow.
Now that actually, it was bad the whole time. But what's interesting is that actually was a huge recovery. So it went from 100 to 1, like 1.5 in 2013, and it's actually in the last decade, the number 1, 2, and 3 stocks have been fabulous. So if you look at 75 years of history, 65 years, number 1 stock's been a bad stock to own. Last decade, it's been fabulous.
Interesting. And I guess so many of the other things that people are pointing to as extremes at this point, whether it's large versus small stocks, growth over value, quality over, I guess, lower quality, they all seem like maybe they're related to this type of preference for these kinds of companies that now rise to the top.
Yeah, and part of this, look, we have to talk about artificial intelligence to some degree. That may be a combination. So the underlying fundamentals are good. We've documented that. But the AI lift in, say, last 18 months has also played into that. And the first obvious thing is what everybody's talking about, which is the infrastructure play, and that would be NVIDIA. But the second interesting question is AI a sustaining innovation that helps the incumbents get stronger? Right. So those lists of companies we see, or is it a disruptive innovation in the sense that new companies will come along? And it feels like the bet, at least for now, and time will tell what the answer is, that it feels like it's just making the stronger.
Yeah, and I guess the other thing that you'd have to investigate to some degree is whether, in fact, there's some kind of behavioral aspect of this, right? I mean, I know you look a lot at investor behavior and herding and the stories we tell ourselves. Does it seem like we can tie any of this to that?
Yeah, I mean, it does feel like that a little bit, right? Fear of missing out, and when you see these stocks do so well for so long. But the other tricky thing is you think about companies like NVIDIA. I mean, I've been doing this for a long time. Yeah. I don't recall ever seeing a company deliver numbers like this. And the operating leverage, in other words, the incremental profits as a function of the incremental revenues is really extraordinary.
Yeah.
So, eventually this is going to end, but for now, it's hard to know how long.
In the meantime, very difficult for stock pickers, which I think is why a lot of professional investors are uneasy about this, right? It feels like you could never own enough of the winners.
Yeah, we looked at the mutual funds that benchmark against the S&P 500. Their average market cap in their portfolio is quite a bit smaller than the S&P 500.
Right.
So when large cap does well, it's challenging for those active managers. When small caps do well, it's the opposite. So under that setting, in 9 out of the last 10 years, large caps have done better. So it's been a difficult backdrop.
Yeah.